A few days ago, I held a subscription box strategy webinar where I talked about the 10 most important promotional strategies that I see $100 million plus subscription box businesses that I work with at Ordergroove using to increase their customer lifetime values, scale their recurring revenue, and optimize their CACs. I received a ton of messages from people who weren't able to attend, so I wanted to share a webinar recap with all of you here. We'll discuss each strategy with performance benchmarks, live discussions, financial modeling case studies, and as always, you can download the model in the description below. Okay, let's get started. So, subscription box strategy webinar. I'm obviously Eric. Thanks for joining. Today's video, I'll introduce myself and talk about why this is sponsored by Ordergroove today. So on today's agenda, we are going to be walking through what I see as the best practices to scale subscription box businesses and just e-commerce businesses in general. Some of the very big levers that I've learned kind of looking across all the different businesses that I've had the chance to work with. So we're going to talk about lead generation, discounts versus CAC, one-time versus subscription promos. We're going to talk about buy one, get one free versus 50%, and then kind of the architecture of 100 million plus recurring revenue programs in the CPG space. Okay, so for those who don't know who I am, I feel like I've never really introduced myself, but I'm Eric Andrews. I work right now as a director of commerce strategy and growth at a business called Ordergroove. We basically dominate the enterprise space of CPG subscription platforms. Usually businesses start on sort of like a small app, Shopify native subscriptions, etc. And then they grow out of those apps because they need to build something more customized as they scale towards being a very, very large subscription box business. So we sort of dominate the enterprise space because we have the most customizable software and a big strategy team to help these businesses scale. I was also head of finance at a business called ID Tech, which was acquired for 200 million a couple of years back. Worked with over 100 startups, helping them build, scale, raise money. And I've trained over 300 founders across 8 cohorts of my bootcamp, Finance for Startups, in addition to a few other things. So that's me. This is for anyone running a subscription box business who wants to optimize promotional strategies to improve the customer lifetime value. And some of you said in the chat that you're just here to learn. These strategies apply to kind of all startups, subscription or not. So these are just general things that I want to uncover and bring to the public that people don't know about, basically promotional strategies. I think there's a lot of unintuitive things that are not widely known. So let's dive in. Okay, cool. Okay, so the first thing I want to bring up is optimize your lead gen. So this is a huge, huge unlock that I'm not sure why people don't lean into more heavily, but consider giving out something huge that your customers would love as a giveaway in exchange for them giving you their email. So like, hey, we're giving away this XYZ thing. Enter your email to be in the running to win this. We're announcing it, at the end of the quarter. So for example, we're about to cover this in the case study. If you can capture an incremental 5% of the emails of your website traffic, people who otherwise would not be giving you their personal information, that could translate into hundreds of thousands of dollars of additional revenue. And so I want to show you a real case study from an eComm brand I worked with that did this exact thing. Okay, so here's the value of lead generation. So I was working with a company. They had 100,000 people coming to the website per month. Conversion rate was 2%. These are like pretty standard numbers. So 2,000 people would purchase. The AOV was about 150. And so their revenue was like 300K per month. The issue is that they were paying $2 to $3 a click to get people to their website because they're primarily promoting their business through paid media. And so they were paying for 98,000 website visits who would just leave the website because they didn't purchase and they would never hear from them. $2 to $3. And so, I looked at this and I was like, there's got to be a way that we can figure out how to capture more of these people's emails, and we can give them something really valuable, so they'll give us their email. So we decided to launch basically a giveaway. It was like, enter your email to win. I'm not going to say what the thing was. It wasn't even one of their products. It was just a very aspirational kind of on-brand luxury product. So it's like, we'll give away this $9,000 thing. Just enter your email, and we're going to announce it, in a month. And so they started launching this once per quarter. And so basically what happened is that the truth is actually they captured 11% of the people's emails through this, on top of the people's emails they were capturing just through the regular purchases. But I just wanted to put 5 in to be conservative, but they actually captured 11%. And so the actual data that they saw was like they were at 300,000 a month of revenue before they did this. But they started capturing, of their 100,000 website visits, an additional 11,000 emails per month onto their email list. And what we saw as we tracked this over the next basically 12 months is that about 5% of these people ended up buying something, which was usually through like email marketing. And so they were converting by offering this sort of $9,000 gift. They were converting at basically 550 additional leads per month. And so on a monthly basis, they were able to add about $82,000 of revenue to their business. And on an annualized basis, they were able to add about $1 million of revenue to their business per year. And their gross profit margin was about 50%. So they were adding $500,000 of profit to their bottom line per year. And so it's like, how valuable of a gift could they afford to give away to make $500,000 of profit? They were only giving away a $9,000 gift per quarter. But I encouraged them. I said, give away a car, give away something crazy. Like, what if we could drive the lead gen to 25% of website traffic? So I think you can push this to extremes, but there's a big opportunity to capture the information of people who come to your website, because if you don't capture their information, particularly their email, because the organic reach has been so sort of throttled on Instagram and these social platforms. Like, even if you have followers, a lot of times they won't see your posts because they won't get shown in their feed. So email is the most valuable thing you can capture, sort of, period. So it's worth giving things away to capture emails. Now I want to talk about discounts versus CAC. This is another thing that I think people don't really have right in their head, which is that if you think about the customer lifetime profit, whether they get a discount or whether you spend the money on marketing, they make no mathematical difference. They both reduce the customer lifetime profit equally. So a customer with a $100 discount and a $0 CAC, or a customer with a $0 discount and $100 CAC are the same. So I want to kind of show a way to sandbox this and see, like, okay, is there a more optimal combination of marketing plus discounts that can maximize my sales and maximize my profitability? So I have a couple scenarios here, and I want to just kind of show you a way to combine these different concepts. So you need to think about discounts and marketing holistically. So let's say we have 3 scenarios, scenario A, B, and C, and we're selling a product, and the sort of base price of the product is $200. Same price in every scenario. And the product COGS, so that's the cost of actually manufacturing the product and then fulfilling the product, is $75 in all 3 scenarios. So it's the same product in every scenario. But let's walk through different combinations of discounts and marketing. So let's say in scenario A, we give no discount, and we're spending about $100 in marketing to acquire every new customer. So what we see here is that the revenue per order, 200 minus the COGS, is 125, minus your CAC. So your contribution margin post-marketing is about $25. That's what you have left over. So what you'll see in scenario B is we have decided to give out a $50 discount And the impact that that had on our CAC was that it drove it down from $100 to $50. So instead of basically paying $100 directly to Facebook, we basically pay $50 directly to Facebook. We give $50 directly to our customer, and the increase in the conversion rate drives our average marketing cost down per customer. So what you'll see is that in this scenario, we have the exact same unit economics, $25 of post-marketing contribution margin. So the discounts plus CAC is 100 in all these different scenarios. And a lot of people, I think, make discount decisions independent of their marketing budgets. And I think this is totally wrong. And then scenario C, we decided to give a $75 discount. So that drives our average order value way, way down to 125. But because we're giving such a big discount, our CAC goes way down as well because the conversion rate goes up even higher. So what you see is again, the same contribution margin after CAC. And so the question that I think it's important to think about is if these all have the same financial profile, you make the same amount of money, which scenario is going to get you the highest sales? So which combination of marketing investments and discounts will get you the highest sales? Sometimes what I find is that just giving the discount directly to your customer can be more profitable than just handing it to Facebook. But these are good things to test and optimize for your total sort of discount plus CAC. So I think this is a really key point. Does anyone have any questions on this subject?
Hey, Eric, one question for you on this. Can you hear me okay?
Yeah.
Okay. Hi, this is Katie.
Hey.
I don't know if you have seen this in the past, but I would think that if you're offering it, I understand the unit economics that you're sharing here, but I would think that if you consistently offer a discount to your customers are going to look for that and they're going to hope for that. So in the long term, if that's your strategy, you might have less recurring subscription revenue from just offering a steeper discount on a one-time purchase or a first-time purchase. Then if your CAC is the same amount, but you don't offer discounts, because then your customers know they're not going to be looking for that signal of receiving a discount every time. So they're more likely to become a subscriber and not churn, because they're looking just for a steeper discount. I don't know if you have any experience with that, but just from the model that you're showing here and from a high level, I completely agree, but I'd love to hear your thoughts on that too.
Oh yeah, and first off, it sounds like a planted question because that's actually the next thing we're about to go into.
Okay.
But 1,000%, you're right on the money. If you train your customers to wait for discounts, it has some really negative effects long term on your business. It becomes like this drug, and then you're always kind of competing for lower value customers that only want to buy with a discount. So we're about to go directly into that subject, but like 100% agree with everything that you just said. It's a dangerous path, but I think if you're analyzing, at the very least, if you're analyzing your performance, I would just encourage you to add your discount to your CAC just to understand your unit economics. And then the longer term strategy around acquisition and retention, I think these bigger questions that you asked are obviously super, super critical. But we're actually about to dive into that. So let's talk about that.
Yeah, I have a quick question.
Sure.
I'm more on the finance side, so I'm not super familiar with the marketing. But wouldn't the customer acquisition costs encompass any efforts like discounts to reach the customer? I guess my question is, wouldn't discount be rolled up into customer acquisition cost?
Yeah, so I mean, just like on a P&L, like obviously your marketing and your discounts sit in totally different sections. And so I think part of that is like why people don't put them together in their brain. But in my mind, your VP of marketing or wherever it is should be overseeing, basically a big pool of capital that they can allocate as they see fit across discounts and marketing spend. So I think they should be managed as one pool strategically, because if you spend that pool to zero, that's effectively the base of your unit economics. And so, yeah, I think they should be tracked together because they're both doing the same thing, basically. It's to acquire and retain customers, and it's like one of your big levers to do that. One thing I want to highlight just before we get into the subscription stuff, 50% off versus buy one, get one free. I don't know how this happened, but the math of these two things is really different. And I just want to highlight something. To the customer, 50% off and buy one get one free feel the same. It's like, oh, I'm paying half the price for the product, right? Yes, to the customer, that's true. But to the business, one of these is really bad and one of these is really good. So I just want to highlight this briefly before we get into the subscription stuff. So let's talk about this really quick. So in scenario A, we have no discount. Scenario B, we have 50% off. In scenario C, we do buy one, get one free, right? So if you have no discount and someone's just basically buying one unit, and for that one unit, they're paying $200. If you get 50% off, a lot of people will still just buy one unit if you have like a high price product. And so what happens is you basically, instead of them paying $200, they pay $100. And then in the third scenario, they pay the $200 because it's buy one, get one free. They're forced to buy two, but they get 2 units. So the average order values are kind of unique in these different situations. So in scenario A, people pay $200, they get 1 unit. Generally, you have some returns. And so that can reduce your revenue by maybe 5%. So your AOV might be $190. For 50% off, your AOV drops to $100, but you can usually, during a big promo like that, say, you know, all sales are final, no returns. So you don't lose money on the returns. And then in the BOGO, you can also say no returns, but you collect $200. And so this is a thing that, like I said, it's a really, really key sort of unintuitive thing. So what we see in our COGS is that 1 unit basically costs $30 to produce, $25 to fulfill, $55. So you collect $190, you spend $55 basically getting the product to the customer. Your contribution margin is $135. And let's say your CAC is $100 in a normal situation. So your contribution margin after CAC is $35. Now in scenario B, 50% off, basically the customer gets a $100 discount and it costs the company $100 of revenue. So what the customer gets and what the company loses are the same. It's $100. So the product still costs $55. Contribution margin is only $45. And again, you usually see a big decline in CAC. I can't say exactly what it would be, but you know, this is basically losing $5 per customer. Now, the really unique thing about BOGO is that the customer ends up having a higher AOV than even an undiscounted order. You have to give them double the product. So $60 versus $30, probably fulfillment costs a little more, but you can package you can pack the 2 orders together and fulfill it together. So it won't be double in terms of the fulfillment. It'll just be a little bit more in terms of weight. But the thing about BOGO is the customer is getting an extra unit, which in their mind is worth $200. But to the company, that is only costing us an additional $43. So there's this really interesting thing where the customer feels like they're getting $200, but it only costs the company $43. And so because of that reason, your contribution margin is actually much, much higher, 103. And in this scenario, because of the decline in CAC, your contribution margin after CAC is actually more with a BOGO than no discount, $53. And I've actually seen this many times play out at companies, but most businesses lean towards the percent off discounts, 50%, 40%, and don't do this math. And like the giving out product, especially if your product has a low cost to the company, is super, super profitable and can drive, you know, this absolute explosion in your sales. So when you're ramping up to a promo, now we're going to get into the subscription subject because we've gotten obviously questions on, more of the long-term strategy. But if you're ramping up to a promo, please do this math to figure out what is the most profitable promo that you can run, and don't run the promo where you lose money on every customer. Okay, so Katie, to just come back to your original question, which, like I said, sounded like a planted question. So one-time versus subscription promos. So what I've seen across a lot of different brands is that the marginal customer who converts via a very large discount, like on a flash sale, usually has a very low lifetime value, lower than a normal customer. And this is because those customers actually won't purchase anything without a discount. And so, like, if you actually run some of these sales, like flash sales, and look back retroactively, what you'll see is that a lot of the people who only will convert with a big discount never buy again. So they're not super valuable. And so if you have a limited discount budget, acquiring these types of one and done customers usually isn't the optimal use of your discounts long term, Okay, so one huge mistake I see is giving out bigger discounts to customers and subscribers. So people will be running subscribe and save 20% subscription program, and they'll do a flash sale of 40%. And then all their subscribers will churn to take advantage of the flash sale, and then they'll acquire a bunch of one-time customers who never buy again. So again, I think this is like long-term, it's not rewarding customers for loyalty, it's doing the exact opposite. It's making them wait and giving them a big discount to buy once. So that's not the right behavior that you want. And so if you're going to give a discount and lower your contribution margins, like, you should give it to the person who's considering a long-term relationship with your company via a subscription. So it's better to give more discounts to your subscribers, and you have to basically calculate their lifetime value. You need to make sure you're still making more money. But if people purchase, over and over and over again on subscription, you can usually find a great combination where the company makes more money and the customer gets more value via discounts. So I would say, measure your discounts out of the same pool of money. And then, a lot of these big omnichannel businesses, I see them making decisions on their flash sales, and the people running their subscription program are like totally independent and they don't talk to each other. And that's like a huge mistake. So, okay, so I want to talk a little bit about a couple of the things that I see very, very large subscription box businesses doing to basically get to 100 million plus in recurring revenue. So, like I mentioned, right now I'm the Director of Commerce Strategy and Growth at Ordergroove. And so we build the platform powering the biggest subscription box programs in the world. So we process billions and billions of dollars of subscriptions, tons and tons of businesses doing 100 million plus, some of them doing 200, 300, 400 million plus in subscription box revenue. So these are some of our big clients that we can list: Dollar Shave Club, Honest Company, PetSmart, but we've got hundreds of merchants. And so in this role, I get to basically look under the hood at all these merchants every single day and see what they're doing to build a really big program. And there's a couple things I want to highlight that I think are really, really, really high leverage, which if you're earlier on in the business life cycle, you need to put these on your roadmap, and you should consider rolling these out, as soon as possible.
Eric,
okay. Sure.
Before you dive into this, I have one question that's kind of connecting the dots backwards, and you might get into this. So
sure.
If I, again, am preempting something, please stop me. But curious if you see, for brands that do implement the BOGO discount, and maybe their subscription tiered structure is just like a monthly discount, is that still a best practice if you are then having a customer come in, maybe it's on a one-time, they do end up having that BOGO, and then depending on what your cohort data looks like, what your LTV looks like, does it make sense typically to offer that when the goal is to still push subscription, where you might get somebody there for 2 months worth of quote unquote product, but then maybe they don't roll into a subscription? Do you find it's better to capture them in at least make up that CAC in that way. And I know that's kind of like, there's so many different scenarios of that, but at a high volume or at scale, I mean, do you see it's typically better to try to capture them in that way or continue to push for the subscription revenue?
Yeah, it's a really interesting question. I mean, I don't have like obviously like a silver bullet answer, but what I would say is that bundles are really powerful, whether that's a buy one, get one free one-time bundle or like a subscription bundle. I would try to calculate the unit economics. Like if you could do like buy three, get five, like sometimes those bundles are like insane. Like you can make like more LTV in one mega bundle than you can make over the entire lifetime of a subscriber. So if your business is a business that can sell product in that way, I mean, by all means. A lot of businesses can't sell a ton of product at one time because they're, you know, in general, like subscription box businesses, a lot of times things you would consume over time. So like if you are selling like pet food, like obviously you want to be receiving that pet food so it's fresh and that the product is, you know, obviously not expiring. You don't want to be buying like 10 bags of dog food at the same time. You want to be like receiving that over time. So your dog can get fresh food. And so in that scenario, I would probably lean more towards figuring out what is the biggest sort of like the best subscription to push the highest lifetime orders up. So I would say like the time, the period of time doesn't matter that much to me. What matters more to me is the LTV. So if it takes you 6 months versus 1 day, like I would just try to push your customers towards the most profitable, basically, outcome.
Okay, thank you. Yeah, I know it's like very dependent and it's all relative. So thank you.
Yeah, no, but I mean, you're thinking about it in like, you know, exactly the right way. So you just need to kind of apply the strategy to your sector. And there's some ideas here we'll talk about, which I think also will give some color. So,
question, Blake.
Sure.
On the bundles, a little bit new to e-commerce. So in your mind or your experience, do you think the customers are okay with a bundle containing a really popular product and maybe one that moves a little bit slower at the same time, but still, you know, you can still make a case for is that they still would like it, they're just less likely to buy the one item? Or do you think that's more of a turn off?
So can you just repeat the question one more time? Just to make sure I understand.
So say you have an item in just some category like golf, right? And you have one product that's very, very popular, sells super fast. And then you have another product that you're having a harder time selling that just moves a little bit slower. They're in the same product category. In your experience, if you were to combine those two into a bundle for the purpose of trying to move that slower moving product a little bit faster, do you find that that can be positive or negative in your client's perception down the road?
Yeah. Yeah, I mean, first off, I think anything you can bundle is great. There's a lot of ways to build bundles. You can build rotating bundles. Those are super interesting where you can swap in and out products. You could have like, let's say a core product that people consistently receive, like you just mentioned, and you could rotate in additional products in and out of the bundles. Like the classic rotating bundle is the wine club, but you can customize these things so to make them whatever you want. You can also have like build your own bundles where people kind of like, you know, get what they want. You know, just in terms of subscription, there's a lot of different frequencies too. So if it's something people need once every 6 months, like they could be on a subscription that renews every 6 months. So I think there's various ways to get at the question. You can also be hitting them with like promo emails to get people to like add upsell. We have this thing at Ordergroove called instant upsell. And basically what we have this functionality where people can add one-off like items to their upcoming subscription order. So it'll just all arrive at the same time. And so that's another way, like via your marketing strategy, you could try to kind of like move more product. So, and if you're really trying to move the product, like it's going to expire, I would consider bundling it and marking it off, down to close to cost to just kind of move it, because at the end of the day, like, you need to get your cash back out of that product, and like if it expires, then that's bad. Hopefully that was helpful. Okay, so I'm gonna keep going, and then we'll do some more Q&A here, but I want to make sure we get through the slides. So here are a couple of the ways that I see brands really successfully basically enroll people into subscriptions, like convert them to get them to buy subscriptions. So one of the things is obviously defaulting your cart to subscription. So, when people add things to their cart on the website, they go to checkout and it's defaulted to subscription. You'll see basically everything I'm talking about here is an example over here. Brands usually see about 114% increase in new subscriptions when they default to subscription. Obviously, a lot of businesses don't like to do this for various reasons, or they think it's not on brand or whatever, but the results are really, really positive in terms of the numbers usually. Also, placing your subscription offer above the one-time offer. So sometimes brands will put the one-time purchase at the top and subscription at the bottom. If you just swap them, generally brands see about a 63% boost in new subscriptions. So we have all this data internally. That's why we know. And then brands that do other design things like this strike-through pricing, make the subscription offer actually a different color, put a box around it. A lot of times see like a doubling of subscriptions. So all of these things are really, really best practices to maximize enrollment into subscriptions. So let me cover the next slide. I got a couple questions in the chat.
Sorry,
Here
Eric,
we go.
can I clarify that? Sorry, this is Jody.
Yeah.
So we're more like an Uber for booking childcare providers. And so I'm worried that if we move our on-demand option where it's like $20 to, use the app to book one sitter and just give them the, say it's a $30 a month subscription, that we would lose the people who just want on demand. So we've kind of gone back and forth with, should we just eliminate and force everyone onto subscription to use the product, or, with some free trials or whatever, but should we eliminate the on-demand option?
Yeah, I mean, I think with two-sided marketplaces, the really important thing to figure out is like, if you need to expand your take rate, effectively capture more value, do you need to do that on the supply side or the demand side, and which one of them will not hurt your conversion? And so Airbnb charges a bunch of different fees and different stuff on the user side, but also on the host side, they're charging all kinds of fees and take rates. And so sometimes you can charge subscriptions to the supply side, like your drivers, right? Like Uber. Or you can charge it on the demand side. And so which one is going to hurt conversion less? Like, you might have an easier time charging your driver subscription. So I think that's a little more of a question of like, what, you don't want to hurt your sales, but can you maybe just expand your take rate, from whatever it is now, 15% to 20%, that might actually hurt your business less than charging your riders subscriptions. You see what I mean?
Yeah, that makes sense. Thank you.
Okay, so first thing, other than these basically updates to the cart. So the first thing that I want to talk about that like 100 million plus recurring revenue brands do is they figure out a way to increase the discounts over the customer lifetime. And so brands that switch from a flat discount, subscribe and save 10%, to like increasing discounts with each order, generally we'll see their LTVs go up by like 10 to 50%. Depends on the business, but you'll see usually a pretty large increase. So usually, so first off, just like show me the incentive and I'll show you the outcome. Like, customers need to be rewarded for loyalty. It makes them more loyal. And so you can usually give them bigger discounts and make more money. And you need to calculate the unit economics, which I want to show you how to do right here. So I'm going to show you an example right now of a company that shifted from subscribe and save 10% to incrementally increasing to 20%, and how they were able to make more money doing that. So this is where we get into the really bottoms up kind of like unit economics. So Let me just give you an overview really quick. So this business has an $87 average order value. They give 10% off, so they make $78, and they say, okay, subscribe and save 10%. Their product costs about $33. And so they're currently making about $45 on the subscribe and save 10%, with a $50 cap. So what they're seeing is, I always like to look at the retention sort of cohortized. So you see order 1, 100% of your customers make order 1. 60% of your customers get to order 2. 30% of your customers get to order 3. 18% of your customers get to order 4. And so if we look at the retention that they currently have, basically that's generating them about 2.6 lifetime orders. Subscribe and save 10%. And they're giving 10% off per order. So on the first order, they make $78 of revenue, $45 of profit, and that's what they make every order. So over those 2.6 orders, they make about $199 of revenue per customer and about $114 of profit per customer. And so at a $50 CAC, they're basically making LTV minus CAC about $64. And so the question is, if we increase the discounts as customers get deeper into their lifetime, will we be able to retain them more? The answer to that question is almost always yes. And if we can retain them a lot more, can we make more money? And the answer to that question is also, from what we see at Ordergroove, almost unanimously it's yes. And so this shift that we made here was give 10% off the first order, 15% off the second order, 30%, and then 20% off the third order forward. So what you'll see is that the revenue on the first order is 78, gross profit's 45. And then when you give the 15% off, obviously your revenue is a little lower, your profit's a little lower. And then once you get to that third order, now you're giving 20% off. So your revenue and profit are even lower. So what you see is that your revenue, your profit are a little bit lower, but our retention per order is going up. So on the second order, we have had only 60% of customers get to order 2. Now we have 70. And then by order 3, the people will continue to get that 10% off, but now we have 50% of people getting to the third order because they continuously get higher and higher discounts. So they retain at a higher rate. So what we basically see in this scenario is that we're able to get people from an average of 2.6 lifetime orders to about 3.5. And so that's about a 38% increase. And then the revenue, even though the revenue is a bit lower per order because we're able to drive so much better retention, the revenue is up 29%. The LTV is up 21%. So it's up to 139 from 114. And then the LTV minus CAC was 64. Now it's 89. So usually the brands that have really successful recurring revenue programs are doing something like this, different variations of it for different brands. But this is definitely where you want to be as a brand. Okay. Okay, another thing here, prepaid subscriptions. This is kind of a new category that I think that there's a lot of false beliefs about, that the data that we are collecting directly contradicts. So let me tell you about prepaid subscriptions. So prepaid subscriptions where you say, okay, prepay your next 3 orders, and we'll give you, 25% off. And then you receive those 3 orders over time, just like a regular subscription. So generally with prepaid subscribers, they spend on a lifetime basis at least 150% more than a sort of month-to-month subscriber. So you can afford to give them a bigger discount and you can still make a lot more LTV on them. Some brands are able to sell annual subscriptions. Like we have some coffee brands, some supplement brands who say, okay, prepay a year of product and we'll give you like this really big discount. Some of those brands are able to drive their lifetime revenue up per customer by 5 to 10x. So there are some pretty spectacular numbers happening with the prepaid subscription. So the common false beliefs that I hear are customers won't like it. Customers can't afford it. The economy, it's not on brand. And that's what I thought as well until I looked at the data. And so basically what you see is that when we look across, we have basically about 16 large brands running prepaid subscriptions right now. what we see is that between 22 and 33% of customers choose a prepaid subscription over a regular month-to-month subscription. So the idea that customers won't like it, 1/3 of customers actually are choosing prepaid subscriptions over regular subscriptions. And the top brands basically have the amount of customers, subscribers in their business, upwards of 50% are choosing prepaid subscriptions. And these brands are just absolutely crushing. It's like very, very crazy. So if 33% of your customers spend 150% more, your revenue grows by 50%, just mathematically, plus you receive all the cash up front. And one of our most successful businesses actually sells a $500 annual prepaid subscription. So again, one of the biggest sort of false beliefs that I hear is like, well, our product has a higher price point. And it's like, you know, we just do not see in the data that that is an issue. So I just wanted to share this with all of you. If you're not already thinking about prepaid subscriptions, start thinking about them. Put them on your roadmap. Consider, could we do a 3-order? Could we do a 6-order? Could I do a 1 year? Because these are a real thing. And I think that they're going to be a big, big part of subscription box businesses going forward.
Quick question.
Sure.
You said the 22 to 33% customers are they're willing to pay the prepaid subscription. Are those customers generally business or consumer?
Are generally what? I'm sorry, I didn't hear the last part.
Are they generally business customers or consumer customers?
Consumer customers.
Oh, really? Okay, interesting.
Yeah. I mean, we're talking about pet food, you know, health supplements, coffee, like subscription coffee companies. These are all consumer brands. So again, the data sort of contradicts what you would think. And I thought the same thing. Like, oh, consumers wouldn't want to pay upfront 6 orders. And it turns out that they do. So this is the interesting thing that we're just kind of uncovering in real time. And I want to start surfacing this to the industry because this is like a really key thing that people, you know, they like to receive a bigger discount. And you can also drive, as the business, the LTV of people way, way up at the same time. So it's kind of a nice win.
Hi, Eric, one more question on that.
Sure.
And I know you said it's a newer exploration for you, but it's something that I've looked into exploring, and I'm in the natural product space. So yes, in CPG, but when you're looking at the tiered discount options, do you typically analyze your cohort data to determine, okay, here are the variables of churn, time variables of churn. So it's like, okay, after typically month 1, that's when most subscription brands see the biggest drop off. But then are you looking at those different time periods to say, all right, so at the 3-month mark is when we see the next biggest drop off. And then at the 6-month mark is when we see the next biggest drop off. So that is how you're determining where you should implement the incrementality of discount and time, or do you take a different approach to that? Like, is it, are you looking at it from a different view? Because the way I've looked at it is like, all right, at month 1, you have the largest churn, but then at month 3, and then maybe at month 6, I'll have the greatest churn.
First off, thank you for the question. So I think that it makes less sense to target specific orders, in more sense to think about how can we drive the maximum loyalty across the entire cohort of customers. So here's why. So a lot of brands, like if you're in this scenario, right, you're like, okay, 100% of my customers get to the first order, then 70% the second order, 50% the third order. And if you see the average, the average customer only makes 3.5 orders, you might say, what do I need to do on order 4 to make sure we get to people to 4 orders? But the reality is that you've already lost 65% of your customers before order 4. And so, like, thinking of it as like, this is the moment in time where everyone's churning. There really is no moment in time where everyone's churning, because they're just kind of consistently churning across every order. You mentioned also that most people churn on that first order. I think if there is a moment in time, like, do it early, and the first or the second order. But I try to think about it more as like, how do I lift the retention across all orders? Because the more I can back weight my discounts and drive the loyalty up, it's going to drive the averages up. But I think that reducing it to like one order or another, I think it isn't quite the right lens. And I think you can get more performance by like saying like, what type of program can I structure to lift my retention just across the entire tail of all cohorts? So that's my view on it.
Okay, so you would just really look at the lifetime order and structure from there versus at what time frame the majority of your subscribers are churning.
Yeah, I mean, I think in general, yes. I think if there's a moment like between order 1 and order 2 where like there's a massive drop off, obviously you really want to diagnose that and figure out like, okay, a lot of brands see that drop off when they give a bigger discount on the first order and a smaller discount on the second order. And it's like, yeah, people are going to drop if you do that. So like, you need to think about what's the program where it drives higher retention the longer they are a subscriber, not lower. So yeah, I think about it a little bit more as like, what is the best loyalty program across all orders, because you can drive up a lot more lifetime value that way.
Okay, thank you.
Yeah, sure. Prepaid subscriptions, put this on your roadmap. Like, I think this is going to be a huge thing. And I think just nobody has the data on it yet. So really key. Customers like this. Operators of e-commerce businesses, some reason don't, but the customers actually like this. So put this on your roadmap. We mentioned also earlier that adding upsells to subscriptions. There's, what we see is there's different ways to like add orders to your upcoming scheduled subscriptions. We build a bunch of different technology to do it in different ways at Ordergroove, but this, this is a key part when allowing people to shop and just kind of receive different things via their subscription. People that add things to their order generally spend about 50 to 60% more per order when they add something via an upsell. And around, if you can design this in the right way, 5 to 10% of customers will sort of add things to their order on any given order. So this is another, you need to be kind of chiseling away and everything you can think of to drive your recurring revenue up. This is one of the things. Bundles. I think bundles isn't so groundbreaking. I think most brands know creating a bundle is probably a good idea. Across our over 500 brands, the average customer has 1.7 per subscriptions. The average individual person has 1.7 subscriptions per brand. So customers are already bundling themselves, whether the brand is keeping track of it or not. And so making bundles easier, creating bundles that represent what people are already bundling, allowing customers to build their own bundles, creating rotating bundles. Customers will buy these bundles. They love bundles. They're already doing it on their own. And it just drives your AOV up at the same CAC, and it drives your lifetime value, makes it skyrocket. So put bundles on your roadmap if they're not already part of your plan. You should be aggressively bundling, whether that's a buy one, get one free flash sale, or that's a bundled subscription. Like bundling is great. Last thing I want to mention is in-store subscriptions. If you have a physical retail presence, selling subscriptions at the point of sale in person is a great conversion strategy. You're already acquiring these customers. They're already walking into the store, so there's like no marginal CAC. It's basically all upside. And one additional thing for large products, some brands are actually selling subscriptions, but they have buy online and then pick up in store. And so generally, if people come to a store, they end up buying way more stuff. There's like this halo effect. So like a subscription where people pick up in store is also, I think, something that has a lot of potential, which I would think about if you have a physical retail presence. Okay, so just at the end, I'll send out this presentation, of course, after the call, but optimize your lead gen. Think of your discounts and CAC in one bucket. BOGO is better than 50% off, usually better than any percent off. Don't kill your subscription program with flash sales. Optimize your product page for subscription conversion. Increase discounts for over the customer lifetime. Launch prepaid subscriptions. Upsell customers, bundles, and sell subscriptions in person. If you can do half the things on this list, I guarantee your business will grow a lot. One other thing if you are interested in learning more about Ordergroove, about the technology that we build pretty much the most customizable platform for large subscription box businesses. If you are doing over $1 million in recurring revenue and want to build a subscription program with higher growth and retention, please come book a demo with us, talk to one of our subscription and membership experts to drive into your recurring revenue strategy and learn how we can help. I'm just going to leave this up here. And if anyone has any other questions, I'm happy to go a couple minutes over today and answer questions.
I don't have any additional questions, but I just want to say thank you so much, Eric. This was awesome.
Okay, so I hope you now understand more about the growth strategies that power massive subscription box businesses and how you can apply them to your business. Thanks to everyone who attended and who's watching right now. This webinar was a blast, and I plan on hosting more strategy webinars like this in the future. If you'd like an invitation to them, please make sure you're on my newsletter, which you can join in the description below. And if you found this video valuable, please like it, subscribe, and share it with other people in the ecosystem. Thanks for watching, and I'll see you in the next video.